The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Are you tired of being misguided by self-serving financial service profit seekers? Are you looking for a better way to take control of your destiny and create a financially free path for future generations? Well, you're in the right place. Welcome to the Banking on Your Retirement podcast. We cut through the noise of the often self-serving financial markets with simplified yet foundational financial principles for creating a more peaceful, joyful, and prosperous life. So be brave and be free. This is your home. Now, here's your Banking on Your Retirement host, Johnnyward.
Hey, welcome back. Johnnyward, host of Banking on Your Retirement. Thanks for joining me again this week. And I have a really special guest that we're going to bring on in a few moments, Steve Selengut. Steve, I met him probably 20 years ago. He had wrote a book, The Brainwashing of the American Investor. And Steve has been, for the last, say, 4 decades or so, been helping people invest their portfolios really with the aim of creating income. And so he's recently, as you can see on the screen, he's recently written a new book. He's in semi-retirement, he tells me. Sounds like he's pretty busy, though. I don't know if his wife thinks he's actually in retirement. But anyways, he wrote a great book in a very conversational way, The Retirement Money Secrets. And, I joked with Steve, about these secrets. And so without further ado, I'd love to introduce Steven Selengut. I don't know why I keep saying Steven because I only call you Steve. So let's bring Steve on now. Hey, Steve, how are you?
I'm good, Johnny.
Oh, that's great.
Good to see you.
Yeah, well, it's great to see you too. We didn't spend a lot of time face to face back in the day, I could say that if the condition you look in, the good health that you look in, is any testament to doing things right financially, right? Which takes a lot of stress off the table, right?
Oh, absolutely.
And that's always good. That side of it is good. If we take the stress off, it's good for our health. And it certainly shows. I'm sure you've done many things aside from just getting your financial house in order and helping others. But I'm so glad that you joined me today. We both kind of come at this slightly differently, but we come at it with the same goal in mind, which is to free people from some of this brainwashing that you talk about on Wall Street. And I did joke with you one day, why is it always secrets? What is this about secrets? And you said, well, it gets people's attention. First of all, I got a couple of secrets. Well, geez, I'd love to hear a secret. Yeah, can you tell me a secret? And we can get into everything that you do, and how you help people. You have coaching services now. You're not managing people's money like you've done in the past, where you were investing and buying and selling and that type of thing that I know of. But you do help people through this book, Retirement Money Secrets, to give them the blueprint of how to do this themselves. But of course, many people like a guiding hand, a coach, standing beside them for some period of time anyways, right? Until they feel like maybe I've got it. And so you help people with that. But if you were talking to somebody who was just getting started in their career, they did want to, they're starting to make a little bit of money. They do want to start storing some money aside. What kind of advice would you give them about what they should do to start planning for the long term in their financial future?
Well, I think the income focus is most important at 2 stages of your investing life. The first stage is when you're just getting started, because income-focused, income-purpose securities are generally the most or the safest on the food chain of investments. I mean, any corporate bond or government bond is safer than any corporate stock. Just because of the nature of the law and how corporations are designed. If you own the stock of a company, it's like owning part of a neighborhood diner or something like that your buddy owns and you've loaned him money. If he owns stock, you own part of the business. If he's loaned you money, you own a bond of sorts. If the place goes out of business, he's got a legal obligation to pay you back the bond and the interest he owes you. He has no obligation to return to you what you invested in the company.
Wow.
That's the difference between stocks and bonds. So I'm saying that people just starting out should not try to guess the next big winner on Wall Street, but rather should develop a portfolio of securities that generate income so that the portfolio kind of grows itself in addition to what the guy is adding to his portfolio every month or every paycheck. It also generates income, and then he can selectively purchase and create a diversified portfolio of securities that generate income. I use closed-end funds for that because they're instantly diversified. You own hundreds of securities in one package. They're not high priced. Like mutual funds can become very high priced. Closed-end funds rarely do for several reasons, which we may get to. So that's what I use. The other point in time is when you retire. You need income, and you've got to focus on income. And if you have the capability of transitioning a portfolio to a retirement mode, that's great. You know, you can sell those individual stocks and move into closed-end funds again that produce income, even if they're still invested in the stock market. They produce income, unlike the individual companies that are inside, which pay dividends, but not nearly as much. And there are reasons for that, and that may be a question we deal with. But in general, when you're getting started, don't try to pick a big winner. Don't take that first IRA or Roth IRA contribution and throw it at the stock market just because you want to hit it big. Be more conservative first and build a $10,000 portfolio before you even think of entering the stock market.
Yeah.
Maybe, that's the type of approach I would take for the 20 to 30-year-olds,
Yeah. Well, I was having this conversation with a friend of mine this morning, and, what's happened to real estate prices, home prices over the last, 3 or 4 years, it's got to be quite discouraging, right? And for young people that they're ever going to own a home, that the $400,000 house now is $700,000, or $250 is now $550, and they're like, I'm just trying to get started, and this thing's just running away from me. And I think there's a lot of sections of our society that promotes the risk taking, the gambling, the ESPN bet app, and it's geez, they're pushing hard on the betting, but of course they're saying gamble safely, right? And I feel that people feel they need to hit that grand slam, right? The younger generation says, well, first of all, I have time to make up for swinging in for the fences, but missing the ball completely, because then I get another at bat. I got a whole bunch of at bats here, but I think part of it is that maybe we don't really love what we do. So, for work. So we end up wanting to hey, how do I get out of this as soon as possible? How do I hit the jackpot? Everybody says, hey, if I won the lottery, now these lotteries now are $1 billion, I guess. So, I hear. And my friends tell me, I'm going to get a ticket. Did you get your ticket? And I'm like, no, I'm not getting a ticket. But if you want to split it with me, that's fine, because of course, you should be fine with $500 million or even a quarter of that. But I would like you to speak to this idea of, be more conservative, right? Be more conservative. Sounds like, that's so boring, right? And so maybe you have some stories about people that hit grand slams in their lives. Maybe they lost half their grand slam or more. Maybe they were conservative because you have many clients, right? That, this worked out because the conventional wisdom is probably not working for a lot of people.
Oh, I totally agree with that. But let me give you an example. When I sold my business last May, I had roughly 110 million in capital assets under management. During the year 2021, where we started with about 90, these portfolios generated $7 million in income. That's base income, just dividends and interest from these closed-end funds that I mentioned earlier. And inside the closed-end funds, it's nothing fancy or, they own a lot of bonds. Yeah. They own a lot of preferred stocks. In the equity side, they own all those common stocks that you'd like to pick one. If you wanted to buy Tesla, you got it. You want to have energy stocks, you got them. They're all in there because they own an average of over 200 different companies inside. So that's where the income, that's the base income, $7 million. That's, 8%. Almost 7-8%. Okay. Yeah. On top of that, during that great market year, we made another $7 million in profits by taking profits on securities. And this is something that you rarely, if you have a financial advisor or you're taking advice from even an accountant, will tell you, you can't do that. You'll have to pay taxes on it.
Yeah.
Okay. So, if you pay taxes, so you don't have the 7 million, you only have 4.5 million.
Right.
That's better than zero.
Well, you took the chips off the table, right?
It's like walking down the street and you see $100 bill on the sidewalk. You don't say, I'm not going to pick up that $100 bill. It might be $200 tomorrow.
Exactly.
You pick it up, you stuff it in your pocket, you go down some other sidewalk and hope you'll get lucky again. That's, the same thing. Yeah. So you got to approach my conservative methodology, which is a low risk environment with that pays a lot of money because of the nature of the closed-end fund vehicle. It's what's called a pass-through trust. And if you guys have been lucky, this is what your parents set up for you to give you money to pay your college education and stuff like that when they were in the earlier years. What the deal is that they have to pay out 95% of their earnings to their shareholders. So just imagine if Amazon or Microsoft or even Tesla had to pay 95% of their earnings to you, the shareholders. It would be a better world. We'd all have a lot more money. Mm-hmm. But they don't have to. And mutual funds don't have to. And ETFs don't have to. Only closed-end funds have to pay that out so that they don't have to pay any taxes at all. So that's the key difference between these things. We own the same stocks and bonds, the same municipal securities, whatever. It's just in an environment where the management of the fund has enough respect for their owners that they want to give them all this money instead of keeping it to themselves. The downside, you're not going to have that ego trip of when the market establishes an all-time high. Your portfolio might not be there because these securities are designed to pay out money, not to reinvest it in more stores or more programs or more software or more personnel or higher pay for the chief executive. They're there to pay that money out to you. So they're not going to grow like those other securities are.
Gotcha.
And that's the reason I've used them. And I've used them almost exclusively for the last 25 years.
Yeah. I do want to dig into that, and I do want to dig into the side of, close to retirement, in retirement, talk a little bit about that. I'm going to get a little plug here for Steve, and then we're going to go to commercial break, and we'll be right back. So Steve Selengut, author of Retirement Money Secrets, has come up with a special. If you buy this book, which you can do by going to the incomecoach.net website and then clicking on purchase the book, and you'll go to Amazon, purchase the book, get your proof of purchase, send that in to Steve, which is contact information is on his website, again, the incomecoach.net, and he will offer you 25% off of any of his coaching services. And I think that what you're going to do, if you do purchase this book, is you're going to enjoy that he's working through a conversation with some retirees. And these people have some goals still, but they're like a lot of retirees. They start to fear they're going to run out of money. And Steve will show you how to help these people, and he will show you how it could help you too. So thank you, and hope you take advantage of this. Thank you.
Have you heard about Liberty Dollar Financial Association? Liberty Dollar is a private membership association that allows its members to purchase silver in different forms, which are lawful for use as mediums of exchange. Liberty Dollar Financial Association is a private alternative currency that is provided to members in both digital and paper warehouse receipts. They also sell physical Liberty coins for your personal possession, or they'll securely store your precious metals for you. They provide members with various services that allow them to use their silver's value as a means of exchange, such as their bill pay service, where they will pay your bills out of your silver account, similar to your current banker. Additionally, they offer a term deposit investment account where currently they are paying out in silver a guaranteed 1% per month, which can be compounded over a 1-year term. Liberty Dollar just celebrated 25 years as a silver bullion dealer, storage facility, and exchange. To learn more about Liberty Dollar Financial Association or to become a free member, visit ldrep.nl/BOYR. That's Liberty Dollar Financial Association.
Welcome back. I'm talking with Steve Selengut. Steve is the author of Retirement Money Secrets. Steve is the income coach, and his website is theincomecoach.net. And Steve, I wanted to jump back into this conversation. I spoke with a prospect probably 3 years ago, and she was in her early 40s, and her parents were in their early 70s. And she says, I don't want to end up like my parents. She says, I don't want to be afraid to do anything in retirement. Like, I'm afraid to spend money. I'm afraid to go to a show. I'm afraid to go on a trip. I'm afraid to spend because I'm afraid I'm going to run out of money. And I think that's a common thing, even with people that have money, right? They're not sure what they can do, right? Because they don't really know what their cash flow is going to be, right? And so I'd like to speak or have you speak a little bit about your experiences with people and how you can actually help somebody who's already in retirement or on the verge of to convert some of their portfolio into this income producing mechanism, right? Because I'll just add one other thing. I feel like I'm knocking my own industry, but I do feel, we talk a lot about accumulation, right? Where, store your money away, stash it into the market, and then we have no plan for distributing the money. We don't know how we're ever going to get it out of there. But the financial industry, services industry, has another product for you. And you had mentioned this to me, that really what you're doing is you're creating an annuity within this portfolio that's been built up over time. And to me, it doesn't require another product. It's already built into what you're doing. And I love that. So you take it away.
Well, that was a pretty good description right there. Yeah, as you grow, your portfolio as you have this in operation, what you'll see is that what I call the working capital, which is the amount you've actually invested in all these little individual securities, these closed-end funds I'm talking about. I mean, I personally own literally 200 and some of them spread out, well diversified and producing more income than my wife and I. And my wife has been personally responsible for bringing the U.S. economy out of recession several times. She knows how to spend money. And when we were living in New Jersey, and she had these friends and that she would shop with, between them, we didn't have any long recessions. Seriously. But you want to be in a position where you can say that it doesn't matter if the stock market goes up or down. It doesn't matter if interest rates go up or down. My income will grow every quarter, every year. My capital that produces this income is also going to grow every year, so long as I don't spend more than I make. Okay.
Yes.
The secret is getting to that position where it makes more. And you have to start early, or you have to convert that IRA or 401k that you've been building over time during your career into this income producing monster that I create using these closed-end funds. And it's not difficult. It's just a matter of looking at the fundamental risk minimizers that you've all heard about, but probably have never put together, like the 4 feet of a stool that you sit on, at the counter. If one of those stools drops out, you fall.
Yeah.
You got to do 4 things to minimize your risk in investing. And you can do that while converting from these low income production mutual funds or ETFs that you've been forced into owning through the limited variety you have in your 401k. So there are 4 things. There's coming up with a way to identify the quality of these new things.
Let's try again.
I don't know. So I was just interrupted. I apologize.
No, that's fine.
So you have to come up with a way to determine the quality of these things. And with closed-end funds, I won't buy anything that doesn't pay at least 6%, for example. It has to be in operation for at least 5 years. It has to have more than 50 separate entities, bonds or stocks or whatever, inside. It has to be well diversified. The other thing I like, and which most people would say, wait a minute, we don't want that, is that it has to have volatility. Because when you get to the point where you're secure in what you own, you know its quality, you want it to move up and down in price, because you want to have opportunities to buy it lower and you want to have opportunities to take profits.
Right.
So that quality is the first thing you look at. The second thing is you need to have your portfolio diversified. Most of you have a limited number of securities in your 401k to choose from, or most of your money is in your own company stock when you retire.
Mm-hmm.
So you could be worth hundreds of thousands of dollars, but it's all tied up in XYZ company, and they don't pay a whole lot of dividends. Mm-hmm. So you have to sell these things to pay your bills. That's not a good position to be in. And when you roll this over into an IRA, you can sell it without worrying about capital gains, taxes, or stuff like that. Mm-hmm. So you create a diversified portfolio. You never want to have as much as 5% of your portfolio in any one investment. Your home is not really an investment. Mm-hmm. Your home costs money. It may turn out to be a good investment.
Right.
But while you're living in it, It's a drain.
It's a
drain.
money-sucking
It's a drain
machine.
on you. Drain. It is. It's like a yacht. It's a hole in the water that you pour money into. That's what it is. So that's the second thing. You got to diversify. 5% is a danger signal. You'll really feel pain if that goes to zero. If you lose that, the bond defaults, or the company, the stock goes out of business, you'll be in pain. I don't have anything in my portfolio that has as much as 2.5%, and I own a lot of different securities. Okay, so that's three. That's two, diversification. The third one is income generation, and that's in retirement or even when you're young. It's the number one important thing. In the first case, because you need to spend some of it, hopefully not all of it, and in the second case, that's what you use to create more capital and more income for the future. So that's just the other one. And like I said, I won't buy anything, any closed-end fund in the income area with less than 6% and in the equity zone with less than 5%. Today, because interest rates have risen, tax-exempt municipal bond funds pay over 5%. And that's an average of, say, 50 of them. The ones that are in the stock market are paying almost 10%. And the ones that are in the fixed income only area are paying around 11%.
Wow.
And your broker or your financial advisor will never talk about them.
Why is that? Why is that?
There are two reasons. Well, there's one. The one primary reason is that, as I indicated before, these things are trusts, and they're designed to pay out their income. They're not designed to grow in market value. And what do financial advisors get paid on?
Yep, the asset value, right?
The net, the assets under management.
Assets under management, yeah, AUM, yep.
The AUM is there.
They'll never tell you to sell.
Right, and there's two reasons why they'll never tell you to sell. The first reason is because then they have to find something else that's going to go up in price, and they're not so sure they can do that.
Right.
But the other reason, if they tell you to sell, oh my God, you got 5% invested in a security. That's not good. It's not safe. You should sell it. If they tell you to sell and that price goes up, there are at least 1,000 attorneys you can find that'll help you sue that guy because he gave you bad advice.
Wow. Yeah.
Because he's supposed to know what's going to happen in the future. And I'm sure, as most of you know, that person isn't on this planet right now that can tell you what's going to happen tomorrow.
Right.
So that's why he will not advise you. And that's why you really have to take charge of your own portfolios. Because investment advisors, not through any fault of their own, may not be in a position to give you that fiduciary advice that you really need at different stages in your investing career.
Yeah.
So those are three.
Three. You got three.
Three. And the fourth thing is what we just talked about, the profit taking.
Okay.
The profit taking is that fourth leg of the stool. That's where any of you have had experience in investing, even as recently as 2020, when we had that COVID drop in March and April. Yeah. You've seen your market value gains become market value losses. Mm-hmm. You've seen those great drops all of a sudden. Oh my God. Many of you have panicked and taken the losses. But if you had a discipline, a profit-taking discipline, reasonable profits all that time, you would have been taking the majority of your profits. And if you had lost anything, it may have been 4 or 5%, not 40%.
Yeah. You mentioned something that, taking control of your own financial vehicles and so forth. I find when I speak to people, we're all about making money, producing, right? Going out and working and getting a return for that effort. But there's so many that say, I really don't understand all of this. I'm not a numbers person. It seems so complicated. And I wondered if you could speak to that, because part of this, maybe the fifth leg, is how do I simplify this? That it's not in my head all the time. I'm not always thinking about money and making money and am I going to have enough money and all that kind of stuff. But also I want to I want to have a discipline. I want to set it, but not forget it. But I don't want to be thinking about it all the time. Can you speak to that, Steve?
Oh, sure. And I think the book, The Retirement Money Secrets, lays out the outline so that if you want to be on top of it, like I am, I'm looking at my portfolio every day, twice, 3 times a day, picking up those profits, buying new things, making all those decisions. You can. But if you want to but when I go on vacation next week for 2 weeks, what you would do is you would set with Schwab or Fidelity, right? You can set a target price and it will automatically sell if you get to a 5% or a 6% or a 7% level.
Yeah.
Whatever you set, it'll automatically sell it. Then at your convenience, you can go back and reinvest the money because the base income being produced by these closed-end funds, you can stay, you don't have to, a lot of people keep cash aside because they think the market's going to go down and they're going to make sure they have enough money to take advantage of it. That's the people who are pretty knowledgeable because they understand that it's an opportunity. But when you have a whole hundreds of securities that are paying 8, 9, 10%, let's say interest rates go back to 0 like they were just 2 years ago, they were still paying over 6% and over 5% respectively.
Okay.
When you know and you appreciate that these things have been doing that for 20, 30, 40 years, you don't have to worry that they're going to stop all of a sudden.
Yeah.
They just keep on trucking. I mean, yes, there are decreases occasionally. So far this year, there have been 52 increases in distributions in the universe that I follow, and only 8 declines.
Okay.
And there have been 12 what I call special dividends. When one of these things will pay an extra dividend. I don't know if it's because they had good luck in the stock market and made extra profits, or something else has occurred that they're paying a special dividend. But that happens too.
Yeah.
These things are unique. They have internal costs that are too high to be included in 401ks.
Okay.
There's a limit of like 0.75% is the most a fund can charge. That's why Vanguard has come out with all these, 0.5%
Right.
funds,
Right.
so that they will be the number one fund in the 401ks, and they've been very successful with this.
Yeah, very much so.
But in my mind, and unlike actually, I think it's FINRA that makes the rules. The financial industry, something,
Yeah.
they make the rules. To them, 2% income in the client's pocket.
Yeah.
With only 0.5% cost. So that's 2% after paying 0.5% is somehow better than 10% after paying a 2% fee.
Yeah.
Okay. No, in the closed-end fund, you never actually pay a fee. It's all the distributions you receive are net of all expenses.
Okay. Yeah.
So you never actually see it. So in my mind, I like 10% better than I like 3%. So
yeah. I think it's a misnomer, right? Is that if I'm going to invest in sort of income funds, right, that I don't get capital appreciation, right? So you're talking about receiving both, and we can go back to, one of these sort of rules of thumb, right, is that you're going to be able to take your portfolio at retirement time and pull 4% from them, right? And that's going to be enough for the long term, and that you're not going to run out of money. And there's financial advisors running numbers for people and say, yep, you're fine. You only got 900,000. how do they even know how long you're going to live, first of all, right? Like, so how do you know? I mean, I'm hoping I'll live to 105. That's my plan. So I'm going to just keep on working, first of all, because I enjoy it. But this idea that you talked about, when you pick a closed-end fund, you're looking at minimum of 6%, right? So you're already, ahead of the game, but you need to be, because 4% is probably, they're saying it's probably not going to work for most people, right? But you're also getting the capital appreciation on both. So it's not one or the other in a sense, right? You're getting both.
Yeah, you're getting capital appreciation if you reinvest the dividends, and if you can take profits to add to that capital base.
Which you're doing because your wife's not spending all the money.
She's not. She's trying. She's trying, but I've been able to keep ahead of her most years.
So there's some extra that you're not taking as income.
So that you can reinvest it and grow the income. The important thing is you got to grow that income.
Yeah, because that's inflation.
Right. But let me, just to make the concept clear.
Okay.
If you have a portfolio that's worth $100,000 and the stock market goes up and now your portfolio is worth $150,000, the amount of income it generates has not changed.
Right.
Okay. If you have a portfolio that generates is worth $100,000 and you take the profits and reinvest them, by the time the market value gets to 150,000, your income will also have increased significantly.
Right, because it's not market gains, right? It's actually
it's realized gains. It's not just paper gains.
Yes.
That's the distinction.
Which is similar to the insurance business in that sense, right? That you're rolling these, if they're paying dividends in these whole life policies, you keep rolling it in and it's realized. Once it's rolled into the cash value and increasing the death benefit, it's a permanent deal, right? But if the market's giving it to you, the market can take it away.
The market does take it away.
And it does,
as everyone has experienced. And when you get to the point, like I am right now, I have in 2 weeks, I get the back end of what this financial company paid me for my business.
Okay.
I get the back end, which was about maybe just around 30%, maybe 35% of the total.
Oh, okay.
And I am hoping that the market doesn't go up.
Right, because you want a buying opportunity.
Because I want the buying opportunity that we have right now.
Yeah, because you're going to have this dry powder that's ready to.
All of a sudden, and I am just chomping at the bit for that to happen. Well, so when you can start thinking that way, because one of the principles also in secrets is that we live. The investment environment is cyclical, and it will always be cyclical for whatever reason. It can be anything, even a pandemic. It can be wars. It can be buildings being hit by airplanes. It can be anything that changes where the market goes.
Right.
You don't want that to impact your income, and that's what this is all about. In the long run, income pays the bills. Yeah. As I say, right there over where the word retirement is, there's this little scribble that you can't possibly read. Okay. I can't read it. It says market value fuels the ego.
Yeah.
Income fuels the yacht.
I love that.
That's the mindset that you have to get to. That if I have enough income, as Steve did when he was 34 in 1979. 34 years old, I was making more money from my investment portfolios than I was earning at my job in New York City.
Wow, that's impressive.
And if I left the job, all the commuting costs be gone. I wouldn't need the coat and tie anymore.
Yeah, and all the fine clothing,
all that stuff. So that was my target. That's what I was trying to do. I said, okay, eventually I want to get to the point where I can say goodbye to these guys and this grind or rat race, whatever you want to call about. And I want to do this. I want to make money. And I think I can do this for other people. And that's when I found two friends that opened up accounts with me.
Yeah.
So.
And the rest is history, as they say.
And the rest is history. And those two guys are still clients
Are they really?
of my firm. And both of them are older than I am.
Yeah.
So there's another thing that you and I were talking about earlier. Making enough income, having enough money to take care of whatever you want to do is good for your health.
Yeah. I mean,
Good for your health.
Yeah, we all hear that saying, right? That, your health is everything. In the end, that's,
Sure.
We can have a pile of money or pile of income, and it doesn't really matter if we don't feel good. But for me, it is a big part of my message is what I'm attempting to do is take the stress off and add the joy back in, in place of it, right? So yes, there's some good stress, as they say, but money is not the thing that that drives our good health if we're worried about it all the time, right? And so to me, what you're doing is income security. It's kind of funny that they came up with, or maybe not funny, that they called it social security. But really what we're looking for is income security, right? And that's
Exactly.
what you've been helping people with for nearly 45 years. So I want to thank you for coming on today. And I do think we'll probably try to do this again because I think we got much more to talk about and share. But I do want to, remind people that Steve has this special 25% off of his coaching services if you provide proof of purchase of purchasing his book, Retirement Money Secrets. 25% off. And it's worth every penny because you're going to make it back and you're going to take some of the stress off and you're going to be looking as good as Steve does all these years later. So thanks, Steve. And I look forward to talking with you in the near future. And thanks again.
Okay, Johnny, it's a pleasure talking to you.
Thanks. Same here. All right. Bye-bye.
Bye.
So, till next week, I'm Johnnyward. I'm the host of your Banking on Retirement podcast. Please like, share, subscribe, and please send comments and questions if you have them. Love to hear from you. We'll see you next week. Thank you.
Thanks for listening to the Banking on Your Retirement podcast. Be sure to follow us on Facebook and YouTube at Banking on Your Retirement. And don't forget to rate and review us on your favorite podcast platform. Thanks again for listening. The information expressed on this podcast is for informational purposes only. You should not construe any such information as legal, tax, investment, financial, or other advice. Personal due diligence is the listener or viewer's sole responsibility.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.